Welcome to session 3 of day 2. Particularly welcome to our remote audience, which is the bulk of our attendees this morning, and welcome to our distant audience in India, among others. I'm John McIntyre. You've met me the first day. It's a pleasure to be here with 3 colleagues who have generously given of their time to partake some of their research, some of their wisdom, and to tell us about some of their activities as they relate to the themes of the event. I'm here to introduce them and question them. We have about an hour and about 15 minutes. So I hope there will be questions from the remote audience and also from the panelists themselves. The first person to present is Dennis Lockhart, and many of you know Dennis. Is certainly familiar to many of us in the southeastern region. He's currently a distinguished professor of the practice at the Sam Nunn School of International Affairs at Georgia Tech, and past president and CEO of the Federal Reserve Bank of Atlanta. As such, he has served on the Federal Open Market Committee. During his tenure, he really was a witness at close range to several financial crises, including the Great Recession, and watched several years of recovery post-Great Recession. He retired in 2017 and joined academia. He's also quite involved at Georgetown and Johns Hopkins. So Dennis, we'll turn it over to you for some general remarks.
Am I coming through? I don't think it's working. Testing. Yeah, this is fine. Well, the subject is the impact of the U.S. dollar on the global economy, which is, of course, a very important subject currently because of the rise in the dollar's exchange value this year. So what I thought I would do is first start with some context about the dollar's role in the U.S. economy in general, whether it's now or in past years and no doubt into the future, and talk about some recent developments, and then make some statements on what are those impacts. And Dan, you're going to ask questions, so we'll have a dialogue afterwards. Okay. I'll try not to be too long in doing this, but I know most of you are familiar with the core financial role that the U.S. dollar plays, but it's worth sort of detailing some of the different dimensions of that role. First, as a reserve currency, the U.S. dollar currently, or at least the most recent data I've seen, accounts for about 59% of reserve currency holdings of sovereigns of countries around the world. If I were to give this talk 5 or 10 years ago, the number would have been slightly above 60%, 62, 61%. So you can see that the role of the dollar as a reserve currency is very, very gradually diminishing, but it's not moving quickly. And there's been much discussion about whether somehow the dollar will lose its position in the global financial system. It doesn't appear to be happening, at least as measured by reserve currency status. It is the major invoicing currency for international trade, including many second and third countries that have nothing to do with the United States, but still will invoice in U.S. dollars. It is the major currency for investment flows around the world, and therefore it's over 90% of transactions in foreign exchange markets involve the dollar as one of the currency pairs. The dollar also is the currency of denomination of many commodity contracts, including futures contracts, particularly in oil and gas. There are offshore dollar debt markets in a number of countries, and the health of those markets is a concern of U.S. Officials, including the Federal Reserve. So the Federal Reserve maintains, I think, something like 13 or 14 swap arrangements with central banks in order to provide dollar liquidity to offshore dollar markets that are not affecting the U.S. economy per se, but are part of a dollar system around the world. The U.S. Treasury is the foundation currency of the global financial system. It is the so-called risk-free rate. One wonders from time to time when we have a debt ceiling crisis, whether it's going to continue to be the risk-free rate, or whether it's risk-free, but nonetheless, it is the risk-free rate, and therefore it's the reference rate in some financial contracts and the reference rate for determining spreads of risky assets versus the U.S. Treasury. Why does the dollar play this role? Well, first, the U.S. economy has historically been the largest economy as measured by GDP in the world. It continues to, by some measures at least, to be the largest economy in the world. The rule of law and the depth of capital markets make the dollar sort of by default about the only game in town relative to other currencies. Some have rule of law, but their capital markets are not deep. So as long as US dollar capital markets remain the deepest and most liquid in the world, the US dollar is going to be important. I've been asked many times whether the dollar is going to lose its status. It is a subject of concern by on the part of the public, and my answer has been probably gradually we will see the composition of foreign currency reserves around the world become more diversified, particularly as other currencies deepen their capital markets and maybe their economies grow, so their currencies can be used internationally more. But that will be a very gradual process, and I don't consider it an unhealthy process at all. So if you roll the film forward 30 years, 25, 30 years, the dollar might at that time be 40 to 45% of foreign currency reserves, down from today's round numbers 60%. And we'll see other currencies that will be held by sovereigns as reserve currencies. Now, this last year or so has been a very interesting one. The US dollar exchange rate index is up 17% in 2022. So that's a substantial appreciation of the dollar. And of course, with that appreciation means the depreciation of all the other counterpart currencies that have seen conceivably their exports become more competitive, but their imports, and this is very important, have become much more expensive because of the dollar's role in invoicing and commodity trade and so forth. The sanctions regime that has been imposed on Russia as a result of the Ukraine war has sort of mixed results so far, but nonetheless is very clearly built around the financial system that is centered on the dollar. So you could argue or make a sweeping generalization that the US dollar is a centerpiece of the sanctions regime that has been imposed upon Russia. That, by the way, has for some years been an incentive for countries to try to diversify away from the dollar in their holdings. We saw in the case of Russia, I think $300 billion have been frozen. So the ability of the US government to require financial institutions, and of course the Federal Reserve, which holds the reserves of many countries, to freeze those assets is considered to be a very threatening development on the part of a country that was worried about access to its own assets, effectively its own dollar reserves. So the sanctions, the role of the dollar in sanctions is a controversial issue, and it seems to be pushing this diversification away from the dollar. But again, it's moving very slowly. The Federal Reserve has come very far, very fast in terms of the policy rate. So the rising rate environment in the U.S. dollar has, in many respects, led a rising rate policy on the part of a number of other central banks around the country. So on a global basis, the cost of capital is rising, led by the dollar. And in order to maintain their foreign exchange position or whatever, other countries have had to respond by raising their rates. That, of course, can, and in some cases already has led to recessionary conditions in certain economies. The rising U.S. dollar interest rates have attracted capital. So there have been capital inflows on a net basis into the dollar and into U.S. capital markets, simply because you can get paid more if you hold dollars and invest them in a particular instrument, of a rate paying instrument. There has been recently illiquidity in the U.S. Treasury market. This is a matter of some concerns, being watched very carefully by the Federal Reserve and the U.S. Treasury, of course. And that has a number of causes, some of which are quite subtle causes. For example, as I read at least, Japan has been selling their holdings in U.S. treasuries, many of which are short-term denominated. So they're selling short-term treasuries in order to arrest the depreciation of the yen. So they're intervening in the markets to do that. That's just one example of a background to this illiquidity that has become a recent concern. Obviously, there's stress on emerging markets and their external financial arrangements, and some capital outflows out of emerging markets into the dollar as it's become more attractive as an investment currency. And that's putting pressure on both the debt servicing as well as the exchange rate of many emerging market countries. Having said that, this is not the crisis that we saw in the 80s or the 90s, or at least not an incipient version of that. And that's because over the last 20 years or more, many emerging markets have developed domestic bond markets and have financed government deficits using domestic currency and domestic bond markets. So the exposure to the US dollar world is not what it was in the 80s and 90s, but nonetheless, it's getting some attention as a potential systemic threat to the world financial system. Countries like China, and I would argue maybe if things continue to deteriorate with Saudi Arabia, but particularly China, are faced with this interesting dilemma, and that is they are highly, highly entangled financially. And China's foreign currency reserves are 3.5 trillion, of which almost 60% are denominated in US dollars. So they're holding, around numbers, $2 trillion, while at the same time, notwithstanding last week's meeting with President Biden, U.S.-China relations continue to be more and more tense, and there's obviously an incentive out there to sort of distance yourself, if you're China, from the United States and dependence on the United States. But at the same time, they have no choice but to hold US dollars as their reserve currency, major reserve currency. And they're therefore highly invested in US dollar instruments. So this is a dilemma that countries face, that geopolitical tensions are one thing, financial practicalities are another thing. And then finally, there's been a rising concerns about systemic risk. You know, a la 2008, whether something could happen, some shock could trigger a systemic crisis of some kind. I mentioned earlier the liquidity in the U.S. Treasury market, which is being watched very closely. But at the same time, in recent weeks, we've seen this mini crisis in the UK related to their pension fund holdings, the announcement by the short-lived administration of trust, and the deterioration of the exchange value of the pound, which of course raises the cost of energy imports and other imports to the UK, putting them in a further recessionary kind of trend. So financial markets around the world are just keeping an eye on some of these smaller kinds of exposures that could trigger some kind of a broader financial crisis. So what are the impacts of these circumstances involving the US dollar on the rest of the world? And I'll be quick and run through these quickly. First, the cost of imports has risen for many countries simply because the dollar is more expensive. And in that would be the cost of energy. And the cost of energy is a sort of double whammy because the dollar has appreciated. And although there's been some volatility, overall, the cost of energy has risen because of the Ukraine war. So if you imagine yourself a country that has to pay for its oil and gas imports in US dollars, that's why it's a double whammy. You're getting hit both in the cost of the commodity and the cost of the currency that it takes to complete a contract. I mentioned debt crises. I put a question mark behind that. We have not seen a debt crisis yet, but it's a rising concern. That would be an emerging markets type debt crisis. The fear of a global recession, which in parochial terms, US terms, doesn't automatically mean the US will fall into recession, but certainly the context of a world economy has some influence on US economic activity. Capital flows, which can be very disruptive to countries, particularly when they come quickly and create pressure on exchange rates, and therefore some need conceivably to intervene to stabilize exchange rates. And then finally, the effect of sanctions on Russia. Russia's effectively been excluded from the US dollar system, or at least we've tried to do that. And the payment system and as I said earlier, some of their foreign currency reserves have been frozen. So it's really freezing out Russia from the US dollar system. So this has been a wild period in this last several months. And the role of the dollar in the global economy is certainly highlighted by the developments we've seen. So Dan, let me stop there and take it away with questions or comments.
Okay. Well, Johnny, do you have a question?
I'm going to defer to you because you have a prepared presentation, which sort of blends rather nicely. So either you present your prepared presentation or engage in a Q&A comment approach, either of the two.
You have a presentation.
So go ahead. Yeah.
It's not on the
And then
dollar.
may I suggest then that the macroeconomy questions be dedicated to the two of you after you have presented Daniel.
Okay. That sounds good. Can I get my slides?
Yeah, it's being loaded.
Okay.
Thank you very much, Dennis. And we are going to come back with lots of questions and hopefully answers after Daniel.
I have some questions. I should write them down before
mine I've written down. So we'll defer to you and have you present.
Slides, yeah. Is there a clicker or? Okay. We're good.
I don't get anything from that.
I think it's, yeah. All right. Okay, so my talk is not going to be on the strong US dollar. I'm a financial economist, and so I think about corporate decisions and asset prices and asset markets. And what everyone is worried about right now is inflation and the Fed's response to that here in the US. And so I'll talk a little bit about inflation and then some, I think, interesting inflation related phenomena during COVID, what the Fed is attempting to do. And then since I focus on investments and investing, I'll talk a little bit about whether or not people should be trying to time the market. Okay, so as we all know, inflation in the US and globally is very high right now. In my lifetime, this is the highest inflation we've seen in the US. Headline reached almost 9%. We haven't seen inflation like this in 40 years. And on top of that, we've also had what I'm going to call hidden inflation, where we're not seeing prices move, but there's other costs due to these supply and demand imbalances. And this was a hot topic back in the summer of 2021, was this idea of skimpflation, where firms weren't changing prices, but they were putting out lower quality products. So you go to a restaurant to get a sandwich, and it's like 6 ounces of meat, they might give you 4 ounces of meat or something. On top of that, we had a lot of stockouts. So there's work by Cavello and Christoph looking at online merchant stockouts or products that are out of stock. Typically 10 to 15% of products are out of stock. In 2019, when COVID hit, we saw 40% of products were out of stock, as we all know, if you tried to buy something online. But even in 2021, we had this elevated stockouts, which if the product's not available, it doesn't matter what the price is. And then I have a little bit of work looking at some supply demand imbalances in the restaurant industry during 2021, looking at how long it takes for people to just get their food. So if you remember in 2021, there was a big labor shortage. So if you went to get a sandwich, it might take you 5 minutes longer than in a typical time. And my co-authors and I tried to quantify this cost, and we show that these increased wait times actually predict future price changes in the food away from home category. So why are we having this inflation and hidden inflation? I think there's some potential reasons. It's hard to nail down exact reasons. Obviously, we've had huge negative shocks to the supply chain, to the production of goods and services due to the spread of COVID and government response. We've had accommodative Fed policy. The Fed during COVID kept interest rates very low to help keep us out of an even more severe recession and boost the employment rate. And we also saw government stimulus. So some work by people at the Fed calculated the US government spent about 20% more in fiscal spending than what they would have in the absence of COVID. Canada was also about 20%, UK about 18%. Some countries like India and China, their spending didn't really deviate from projections. In this work, which is really hard to quantify, but they estimate about a 2.5 percentage point increase in excess inflation in the US due to this additional spending. But there's a lot of debate on the drivers here. Another commonly proposed reason for the inflation is that the job market in the US is really hot right now. If you look at the number of job openings per unemployed individual, it's a ratio of about 2. So there's tons of potential jobs out there for an unemployed person. What this is going to do is give workers some bargaining power. We've seen wage growth increase dramatically over the past year or so, although it does seem like there are some cracks forming in the job market, at least here in the US. A number of major companies have announced layoffs, both in the tech industry and outside. So Ford, Walmart, Robinhood, Redfin, across these industries have announced either freezing hiring or starting to lay off. Other signs of cracks, real wages are falling. So once you adjust for inflation, real wages are falling. And nominal wage growth has slowed down over the past few months. So here are some other factors or phenomena. We've talked a lot about the Russia US invasion. So I'll kind of skip this. We saw gasoline prices increase dramatically, food prices increase. In Europe, the price of natural gas increased dramatically over the summer as countries in Europe built up their reserves of natural gas, although a lot of these prices have started to come down. Other reasons for why we've seen these dramatic price shifts is we've seen these huge shifts in what we're consuming over the past few years. So when COVID hit, we all just bought groceries and didn't really spend money on anything else. And as we've come out of COVID, we've shifted in the other direction. I think it's taken a lot of companies off guard. And if you tried to fly this past summer, I was flying to Europe for a conference, you'd spend hours in line because they didn't have enough employees there. So this can create some supply demand imbalances as well. Other sort of nuances to the inflation story is during COVID, we had this huge shift towards remote work for white collar jobs. And this has allowed people to live further from their employer. So there's some documented work on this donut effect where people are moving from inner cities to the suburbs. Also, I have some work showing that people are moving to places like Idaho and Texas, lower cost of living locations. And Redfin has done some work showing that places where people are moving to during COVID are also the places experiencing the highest rates of inflation. So Atlanta is a city that's experienced net in-migration during COVID, also some of the highest inflation during this period as well. So these are some kind of a walk down memory lane of some of the drivers of inflation. It seems like we've got some good news on inflation recently, that inflation hopefully is rolling over. Core and headline inflation were lower last month. Food and energy prices are falling. Supply chain issues seem to have moderated some. Shipping costs are down. There's way fewer ships outside of the LA port right now than there was previously, and wage growth has moderated some. So what is the Fed doing? The Fed's still, the inflation is too high for them, so they're looking to hike interest rates to tame inflation, try to cool off the job market, especially, and for investors, what I think the big question is, how serious of a recession is the Fed going to induce and to get inflation back under control? And so the Bank of America did a survey of fund managers this past month, and they asked fund managers, what are you expecting to happen in 2023? And 92% of them said they predict stagflation. And 4 out of 5 expect some sort of a recession in 2023. So what's stagflation? It means high inflation and low GDP growth. That said, investors don't really expect the Fed to increase interest rates that much more. So about 100 basis points more. If we look at expected future paths based on future prices, we expect a peak Fed funds rate of about 500 percentage points. It's currently at the range is 375 to 400. And also investors, if you back it out of asset prices, are expecting relatively low inflation over the next 5 years. The expected average inflation is 2.3% here in the US, even though it's 8 or 9% currently. So it seems like investors expect the Fed to get inflation in line relatively quickly. Okay, so since I teach investments, I get asked, should you be speculating on what you think the Fed is going to do or what's going to happen in the economy? And my suggestion is probably not. I've done some research on individual investors and whether or not they're good at market timing. And the average individual investor has no idea what's going to happen. Their flows into and out of the market have no correlation with future market returns. There is a select group of individual investors that seem to be skilled. If you're one of them, do it, but most of us are not. And also, don't take huge positions. A lot of individual investors are overconfident in their ability, especially men. So there's some work from 2001 by Barber and Odin showing that men trade too much. They think they know what's going to happen in the market for different stocks, and it hurts your overall performance. Women also do the same thing, but it's not as drastic as for men. So to summarize, it seems likely we'll face some sort of economic contraction. Fund managers are predicting most of them are predicting a recession next year, and potentially some inflation over 2% for the next year or so. So what you do as investors, I would suggest not speculating, focus more on risk management, make sure you're ready for some downside shocks that could potentially happen. Thank you.
Thank you. So we're going to basically break the presentations in two parts. This is the first part, the macro part, for both Danielle and Dennis, who have really set up some broad parameters and define and try to sort of forecast to some extent. But here to my right, we have a gentleman who has been involved in the Federal Reserve Open Committee. So I'm going to ask you, based on Danielle's work, how serious of a recession will the Fed induce? You used to chair one of the regional reserves. So how do you assess the current policy of the present reserve under the current president of the reserve, a political scientist, if I recall by training? I'm not sure, but I think I am
A banker by training.
a banker, but with a political science background. And given also some of Danielle's broad findings, what's
Well,
your sense?
First, you got to start with the point that we are not in a recession now, in all likelihood, not a recession. Recessions are called by a committee after the fact. They look back and they evaluate a variety of different indicators, employment being one of the indicators. And then they say, well, from this period to this period, we were in a recession. So we won't really know officially until many, many months after the actual period. But so we're starting from a point of the broad economy is in all likelihood growing somewhat right now, and therefore we're not in a recession. So the question then becomes whether another 100 basis points of Fed tightening might induce a recession, or the inverse of that question is a soft landing still possible? Well, I would say that a soft landing is becoming less and less probable, and it's tied to the persistence of inflation. And Daniel mentioned the most recent news on inflation in the U.S. economy. I would say it's encouraging, but it's simply 1 month, and it's just way too early to claim that inflation has rolled over, or that the future is going to produce more good numbers that show inflation declining. So we're just going to have to wait and see. So if you can tell me what the inflation numbers will be in coming months, then I can give you some kind of an educated guess of whether the Fed's response to that is going to induce a recession. And I'll end on an important point, and that is there are recessions and there are recessions. There are short-lived, rather shallow recessions, parentheses. Unofficially, I think many Fed policymakers would accept that if that brought inflation down. And there are deep, severe, long-term or long-lived recessions. Clearly, they want to avoid the latter. So I a little bit jokingly say we should use a hurricane category kind of system on recessions. Is it a Cat 1 recession or a Cat 5 recession? And a mild recession, I think, has relatively high probability. The Fed, this is a nimble Fed. They will react quickly if they see things deteriorating badly. So I would put a lower probability on a deep recession.
So that, if I may, this is not a Paul Volcker Fed seeing rising rates as a necessary curative period to really ensure.
Well, the problem they're facing is not a Paul Volcker type problem. It's not inflation that is out of control or is accelerating rapidly into the teens, measured teens. Daniel cited some numbers. If you look under the hood, the most recent CPI core numbers, which excludes the effect of energy and food, was about 3.3%. That's a run rate that is getting close to something that's acceptable to the Fed. So I would characterize inflation at the moment as relatively plateaued at a level that is too high for the Federal Reserve to accept. But we're not seeing hyperinflation, and we're not seeing it get out of control. So a Volcker response is not necessarily needed under the current circumstances. Having said that, Jay Powell is channeling his Paul Volcker avatar or whatever.
That's what I thought. Please go ahead and provide your own view on that as well.
I want to ask on how important do you think financial conditions are to the Fed when they're making these decisions? Because it seems like if Powell does something and then the markets react very positively, it's almost like he wants to come out and say, like, please don't react positively. Like, we need weaker financial conditions. If asset prices go up, that's going to hurt. Yeah.
Well, financial conditions are where the rubber meet the road in terms of Fed policy actually affecting the real economy.
Yeah.
So financial conditions are extremely important. And in every meeting, there is some time devoted to a review of financial conditions and what has happened since the last meeting in terms of financial conditions. So the Fed recognizes it cannot control many financial conditions. The 10-year Treasury has gone from 420 to 370, 50 basis point decline in the last couple of weeks. So that has been an easing of financial conditions, which is not what the Fed really wants to see happen, but they can't control it.
Yeah.
So financial conditions are very important. But as I said, the Fed doesn't have control over much more than short-term interest rates, and just has to let the market be the market. The other thing I would say is policy is not set to necessarily, in a direct sense, create a certain specified set of financial conditions, and certainly not set to respond to the market in a tit-for-tat kind of way.
Mm-hmm.
The focus is really on conditions in the broad Main Street economy.
Yeah.
And the financial conditions or the financial markets are the method of getting that medicine through to the patient.
Yeah.
There is a question. This thing doesn't seem to be working. Yeah. There is a question that is a little away from the US economy, but has a direct impact on emerging economies, given the fact that a good part of this two-day event focused on India and other emerging economies. Fed rates have an impact on them. And I think, Dennis, you alluded to that. What's your expectations in terms of the double whammy effect on emerging economy? Are they likely to go into recession if they're not already, while the US sort of coasts along through a stagflation period?
Well, it's certainly not helpful if you're India or if you're another important emerging market to have US monetary policy making your challenges more severe. And this has been an issue that comes up from time to time, whether Federal Reserve policy should take into account its effect on the rest of the world. And I've gotten that question many times over the years, and my answer is not meant to sound harsh or heartless, but realistic. The Federal Reserve is a legal creature of US law and is by law to focus on the American domestic economy. And what that means is policy is not made to reduce pressure on India or reduce pressure on emerging markets. And in a a very practical sense, everyone is on their own in the global economy. So policy is set to influence employment and inflation in the U.S. domestic economy. The spillovers to emerging markets are they're just a collateral, a collateral effect, if you will, of U.S. Fed policy. And, there's sympathy, but there's no way to really try to lessen the blow.
Do recessions in other countries help to potentially ease inflation here in the US as well, if it suppresses sort of global demand for?
Yeah, conceivably recessions in other countries can affect global demand, which should put downward pressure on those prices that are set on a global
Yeah.
basis, or that are tradable goods or tradable services and so forth. So yes, in that respect, the way the Fed tries to look at both net exports and global financial or economic conditions is what comes back to influence the U.S. domestic economic activity. And as you know, relative to some other countries, the U.S. is somewhat more insulated from global conditions because this is a more self-contained economy than major European economies, for example.
In the remaining in the remaining seconds, particularly turning to you, Danielle, I wanted to look at the paradox really of being on the cusp of stagflation, possibly. You indicated that as one of the predictions of, I think, a group of economists, one of the chosen forecasters you highlighted, and the paradox of an employment rate that is really quite good, and lack of market discipline, creating labor wage issues and plain old labor issues. How do you reconcile that? And when do you think the labor environment and some market discipline will be restored?
I think one theory that's been proposed is this idea of labor hoarding, where people, even if they're expecting a recession, they're holding on to their employees or continuing to hire, and say, if it's a soft recession, we'll just hold on to these employees so we don't have to bear the cost of losing them and then rehiring new people in the future. And there might be some truth to that story. So even if they expect a recession, they're going to continue to hire. But yeah, Dennis.
Yeah, and that I've heard anecdotally, and I think I suspect that the Federal Reserve is also hearing this from their contacts, that there's a lot of reluctance on the part of employers to lay people off because they're afraid they won't come back. They won't be able to get them back. That's different than in years past. And so the classic demand supply adjustment that can take place in an economy, in this case, the U.S. economy, won't work quite so smoothly if there's wide fear that we're in a chronic tight labor market and you just can't afford to lose your employee base. So that's something relatively new. And I think it's a plausible case to be made that there are some structural forces at work in our labor markets. Demographics are simply a fact of, and in COVID, early retirements of baby boomers that have not come back to the labor market is one of the influences. And the older they get, the less likelihood they're going to come back. And so I think you can make a plausible argument that we're in an era now of tight labor markets that will last a long time.
Just a minor point on that. There is some work which should be taken with a grain of salt that over 1 million people are out of the labor market due to long COVID as well. So that's another potential. factor.
But do government programs or government largesse have something to do with that? I mean, if you look at Europe, that's definitely a factor. In the US for a while, had some very generous benefits. Could it impact? Could it be one of the structural changes? But I don't think it's a lasting one in the case of the US.
Now, the fiscal stimulus, that money will run out, although household finances are in rather good condition. And that has certainly fueled the underlying consumer demand, which the Fed is trying to suppress, but trying to suppress it with consumers not in bad condition financially. Credit card debt is rising, so you're beginning to see the phenomenon we saw in 2008, 6, and 7, for example. But overall, the consumer still feels confident. There are a couple of things that influence consumer thinking in terms of spending money. One is job security. And if they're concerned about their actual job, then the likelihood of being able to find a job influences spending as well. So you have to look at this set of circumstances and say almost everyone who wants a job in the American economy has one. And if they're concerned that their particular company, it's Amazon or somebody, is going to lay them off, they're seeing 2-to-1 ratio of openings to unemployed. So the conditions are pretty optimistic in terms of retaining your income and your job security. So that's going to continue to put upward pressure on consumer demand, which has influence on the overall economy and on inflation.
So no expectations of a changing unemployment rate for the coming foreseeable year,
I think it will rise,
somewhat.
but it will rise perhaps into the 4s.
Yeah.
If it rises above 5%, then I think the Fed will get concerned. They have a dual mandate, so they have two objectives. And I think the Federal Reserve would accept, in fact, people have said they would expect higher unemployment rate as part of a way of bringing inflation under control.
Well, thank you very much. This concludes the first part of the session, which was the macroeconomic part. Danielle, Dennis, immensely grateful for your insights and providing really some clarity in a very complicated interdependent situations with variables that seem to be going in different directions than the usually expected way they behave. Thank you so much. We're going to move to the second part of the presentation, which has a different set of emphasis with my colleague, Alex Odle, who is a professor of strategy and innovation and is the lead on the Creative Destruction Lab, the CDL, which is a global initiative coming out of the University of Toronto. It's a unique initiative, in fact, and it's particularly relevant to this event because we are focusing on global digital transformation and disruption. And you'll find that what Alex tells us about is a practical ground floor approach to really creating enterprise in various digital fields. So he has been working very hard for the past 2 years in implementing the creation of a pole or the creation of a node as part of the global CDL. By the way, one of the latest creation of a CDL is in Estonia, little Estonia, which has a high proclivity to create entrepreneurship. I am sure Alex will not have that problem in the southeastern United States or in Atlanta. So the floor is yours. He's a distinguished young colleague of mine, so it's a pleasure to have him here today.
Thanks, John. And good morning, good evening, everyone. This, this introduction to this program departs a little bit from, the talks we heard earlier within this session. but I think sort of ties together this this notion of how does one drive growth in an uncertain environment. This program, the Creative Destruction Lab, which you can see is very international at this, or quite international, 6 countries at this point, but has had great success in bringing very early stage science-based ventures to market on an international scale. And so the mission of the Creative Destruction Lab, or CDL for short, is quite ambitious and is nothing short of enhancing the commercialization of science. And so science is at its core, but for the improvement and the betterment of humankind. The earlier 2 talks, we heard a lot about sort of global uncertainty and how do we drive growth. Science has been one of the most important drivers of economic growth. Since the Second World War, there's been massive amounts of public funding flowing into sort of provisioning of academic science, and yet it is still quite difficult to commercialize that science. So, given that this entire conference, this entire workshop has a global focus, it's useful to start maybe with a picture of the globe. And so, picture the world. And picture, where the top research universities from all around the world lie, right? So, we have, very strong, sort of Indian focus here. Think about the IITs, world-class applied science institutions. Think about the world-class universities in Singapore, in Japan, in Europe, throughout the United States. Here in Atlanta, we are home to 3 R1 research universities. If we expand our geography a little bit, that's 4 R1 universities, including the University of Georgia. And so we'd see a relatively sort of lumpy but even distribution of world-class research universities all around the world. When we talk about the commercialization of science, though, and we were to hone in on venture starts or venture births that are predicated on science, we'd see a much, sharper concentration, primarily in the Bay Area, Boston, and a few other locales. There's a very large disconnect between where science is being conducted, where science is being produced, and where it is being commercialized. Our belief, and this is the thesis of the lab, is that it's not that there are better ideas in Silicon Valley, right, or the Bay Area. It's not that there's inherently more capital either in Silicon Valley or the Bay Area, nor is it that individuals that reside in the Bay Area simply work harder. In fact, I have many friends that are former academics that have moved and worked at startups, and they're shocked that on Fridays at 5 o'clock, people stop working. They don't work through the weekend. And so what is it, that sort of explains this discrepancy again between where science is being produced and where it's being commercialized? Our belief is that there's a failure in the market for high quality judgment, that this is a critical input in helping early stage ventures discern how to scale. And there are very few regions in the world that have this judgment, this advice, this ability to allow early stage companies how to prioritize their time. That the Bay Area has in abundance, and that is what this program is meant to overcome. Let me start with an example. This is an example of judgment in Silicon Valley. Here we have an email that's it's an older email now, 1997, that more or less sort of sets up a business, right? We have a number of assumptions listed out here. Cost per employees, et cetera. This seems to be an ad-based, sort of business. What the cost is will be per ad. What the costs are as well. This is, sort of university-driven business. These individuals appear to be at Stanford, right? What the costs of labor are: $100,000 for labor, programmers, faculty and consulting, et cetera. Sort of $500,000 to really get this venture off the ground. A few comments here in this side, right? Most people pulling 5% of their traffic, analysts saying it's a 30 to 40 million market. So, there's something going on in here in the margins. They then outline, the author of this email then outlines what the benefits would be to potential acquirer. This is Excite. For anyone who remembers the old Wild West days of the internet, the early stages of the commercial internet, 94, 95, Excite was a very sort of prevalent search engine, Lycos being sort of another one. I don't want to date myself too much, but I think we all remember these older search engines laying out what the general business would be, right? Ad revenue increased by 10%. This guy Vinod here in the corner saying, well, maybe closer to 2 to 4%, but aggregates up to around a 7 million total gain in the first year, right? So $500,000 cost, $7 million gain in the first year to Excite. This seems like a pretty good sort of break even decision, 1 month break even. Now, as one does potentially with these emails, lays out, this is thinking about how to pitch this particular technology, this particular business to Excite. What are the losses to Excite, right? If this technology goes to competitors, around 2.3 million in potential losses, right? So not subscribing, not using this technology will have sort of large impact to Excite. Here comes the proposal, right? Work full-time exclusively for Excite for a minimum of about sort of 7 months until August 24th. August 24th is a funny day. For anyone who's familiar with the Burning Man Festival in the Bay Area, that typically starts August 25th. This individual did not want to miss the Burning Man Festival out in the desert for fear that this consulting project would get in the way. The other continued proposal, continue consulting 1 day a week, minimum of 1 year, etc. A number of compensation options, maybe cash, maybe stock, preferred salary. Give me a salary and I will sort of be an employee of yours and give you this technology. Or you could possibly acquire a company which owns this technology. Again, this is Vinod's thought, right? To maybe start a company and then you can just acquire this company outright. Let me know what you think. Does anyone know what this company is? Close. Larry Page. This is Google. We'll talk about Sun Microsystems shortly. And that Vinod is Vinod Khosla. What we have here is Larry Page was going to give away Google PageRank for $100,000 in salary. He'd be more than happy doing so, as long as he didn't miss Burning Man. And it was Vinod, right? Vinod Khosla, the founder of Sun Microsystems, probably one of the most eminent technology companies in the pre-personal computer era, who's who was at Kleiner Perkins for quite some time. He was at Kleiner Perkins at this time, started as an angel investor, now runs, Khosla Ventures, one of the, most, sort of eminent, sort of deep tech, venture capital firms who intervened with Larry, provided judgment, right? Larry had great technology, right? These great technologies exist in a wide variety of different geographic areas. What he didn't have was no knowledge and capacity on how to navigate this commercialization. Vinod did. It wasn't because either Vinod was a venture capitalist himself. A lot of venture capitalists will say, this is what I need to see for me to write a check to you. And you as the entrepreneur say, well, how do I get there? And say, good luck, right? You're on your own. We don't know. We haven't done it. Vinod is unique. He was the founder of a company. He had been there before. The Bay Area has this en masse. Prior generations of individuals that have developed entrepreneurial judgment. That's what CDL is all about. We bring this together by bringing together mentors, exited founders, highly, sort of successful founders, together with, with founders that require this critical input. The reason we frame, so I'm an applied microeconomist here at Scheller as well, less on the macro side of what we heard earlier, but I think about market failure constantly. A startup requires a variety of different inputs in order to scale. They need computers, right? If they give a talk, they need microphones. They need a variety of different things. There's no market failure for that. If you need a laptop, right? If this Dell laptop breaks, one runs off and goes to Best Buy and one has a new laptop within an hour. The markets work very well for that. Judgment, on the other hand, is much more difficult. You can't go to the store and buy 1 unit of judgment. If you could, it might be bad judgment as well. This is also one of those goods that are referred to as experiential goods. You don't know how good the advice is until after the fact. And even then, you don't know whether or not it was implementation or the core of the advice that is missing. What we do is bring together mentors, a collective of mentors who have been successful entrepreneurs to help these founders. It's structured, and I'll tell you a little bit about the program really quickly. It's an objective setting program. So there's many things, again, that startups need. We don't provide many of them. We simply provide focus and objectives on what each individual venture should be focusing on over the next 8 weeks. These are very early stage companies, typically pre-revenue, typically with a founder who has just left the lab, typically with some type of technology that has emerged from within a university setting. And it involves 5 single days over a 9-month program. In the morning, we have these sort of, thought of as small group meetings where founders meet with mentors in order to sort of hash out and understand what their problems are. And the afternoon is this large room discussion, and I'll point out a few individuals that are in this room right now. That's Anush Ansari from the Ansari X Prize, which was sort of the X Prize for sort of human flight. That's Barney Pell, who ran an 85-person team at NASA and put the first artificial intelligence-driven rover on the lunar surface. That's William Tunstall-Padot, who created a company called Evie, which was sold to Amazon and became the core AI engine for Alexa. So that's the type of caliber of individuals that sit in the room. And each venture is given 10 minutes, each day of these 5 sessions. That's it, where the 3 things they should focus on are honed in on by the collective group. There's a variety of individuals at play. So as I mentioned, it's a 9-month program with 5 full-day objective settings. So it's not a residency program. People fly in from wherever they happen to be. This helps one overcome some of the limitations that many local ecosystems have, where they haven't had successfully exited founders. A number of excellent founders, Barney Pell, as I alluded to earlier, Siobhan Zillis, who's been to the office of the CEO of both Neuralink as well as Tesla, Patrick Pichette. I had to amend this. He was the board chair of Twitter up until a few weeks ago. Now the former board chair of Twitter, but he was most well known as being the former CFO of Google during the early days as well. We have Elizabeth Cayley, who created a company called Meta, which was then sold to actually the Chan Zuckerberg initiative. It was a science-based sort of search engine. William Tunstall-Padot, Sally Daub. We also have scientists in the room, and this is why we have focused on each of these sites are housed within world-class research universities where the technical expertise is particularly strong. And so just a smattering of some of the scientists, Jeff Don, who runs Tesla's battery research group, Yoshua Bengio, for anyone who's interested in sort of artificial intelligence, he won the Turing Prize in 2018. The Turing Prize, widely regarded as the Nobel Prize for computer science, and he received it for his work on deep neural nets. Raquel Urtasun was the head of Uber's advanced technology group. That's where a lot of the autonomous vehicle research work was being done. Christian Catalini, who's actually a co-author of mine, he created MIT's crypto economics lab and was one of the co-creators of Libra at Facebook. We bring in scientists here, not for the ventures. They are there in the room to help business ventures establish whether or not there is a there there. We try not to use the T word, which is Theranos, but I just did, another venture with some significant uncertainty and sort of fraudulent propositions that were attributed to its core technology. Here we have scientists from world-class research universities that help the business ventures establish whether or not there's veracity to the claims of the founders. As a result, I think one of the main reasons, and I'll sort of wrap up in around 5 minutes or so, John. One of the big hindrances that I hear from many individuals at sort of metro chambers of commerces and sort of business development sort of entity state level across the country is that, well, if only we had more capital, all our problems would be solved. We found that simply by de-risking the underlying quality of these ventures, venture capitalists flow, right? This we somewhat heard a little bit earlier as well with Dan's discussion. Capital markets are incredibly fluid these days, and we have top venture capitalists, primarily from the Bay Area, because that is where the majority of them are headquartered, that come to these sessions. Focusing a little bit more on the global aspect, this is a very new program. It's only 10 years old. It started at the University of Toronto, again, with this observation that there was excellent science being done in one's backyard and less commercialization. It then expanded to Vancouver in 2016, 4 years later, and is now, as John mentioned as well, also expanded to Estonia. There's a new site in Berlin. I brought it here with my colleague, Peter Thompson, to the United States. We're a first sort of US site. It's also now at the University of Washington, Seattle, as well as the University of Wisconsin, Madison. And not only a variety of sites, but a variety of various streams. So one stream that I run here in Atlanta is a joint global stream on space technology, on space tech. And so this is more or less predicated on the massive drop in the cost of bringing payloads to low Earth orbit. So just, as a bit of an aside from the space shuttle program, used to cost around, sort of $50,000 a pound, approximately, maybe $50,000 a kilo, like $60,000 a kilo, to send something up into low Earth orbit. This tends to be, 400 kilometers or so out into the atmosphere. That has dropped to around $3,000, right? So sort of a 20-fold drop in the cost of sending payloads up has drastically changed the types of payloads that are now economically viable and economically feasible. And so we have a stream focused on space. There's a quantum stream. There's a neuroscience stream. There's a fintech stream that's run out of Oxford. A wide variety of streams that exist. And so we operate. There are 5 sites in Canada, 3 in the United States, and 4 in Europe at world-class research universities. Our program here is run out of the Scheller College of Business at Georgia Tech. I'm going to sort of focus a little bit more on the international aspect. We had applications. These are sort of founders from over 80 countries around the world. A wide variety, a number of universities, colleges, institutions that have been represented. Many founders holding advanced degrees. Not doing much better actually on sort of female founders than many other programs as well. And as one can see, most of these companies have products that are still very early stage. How do we measure success? Yes, the program has expanded, but our main metric of success is how much equity value has been created by the companies that have gone through the program. And to date, in just the short sort of 10 years, of the alumni companies that have gone through, 20 billion in equity value has been created, including a number of unicorns. Okay, and so this is sort of the very end. To sort of summarize, science is important. Science is one of the most important drivers of economic growth, and yet commercializing it is much more difficult than commercializing other types of technologies. The Creative Destruction Lab creates, the lowest barriers possible of entry to the highest performing founders focused on science-based ventures to scale these ventures into something that's massive. Thank you for your time.
Really impressive presentation, impressive program, and I've known about it for a while, and I'm always struck by what has been achieved. It's quite remarkable. $20 billion in additional value created by going through the process for the participants is impressive. Do you think this program would apply in emerging economies? I'm just curious.
Most certainly. It's this. Let me sort of flip it. Would this program be required in the Bay Area? No. Right. And this is to a certain extent why I provided this, this earlier example between sort of Larry Page and Vinod Khosla. The thesis really behind the lab is that this is what the Bay Area has in abundance. Is this judgment? With the numerous, sort of IITs that exist in India, and I can't, sort of give like, sort of too much away, but the lab is always thinking about expanding, especially into emerging economies.
Okay, great. We have a very limited audience physical today, but we have a remote one. We have a very little bit of time. We have a new session coming up. Anyone in the audience physical audience, wanting to raise a question? Go ahead.
Alex, excellent presentation. I have a quick question. In terms of the mentors you have are mostly, experienced, entrepreneurs and technologists and scientists and all. But what is the selection process of the companies who you bring on board?
So great question. We have around a 20% acceptance rate. So it's quite competitive. We have an entire team. And so you might think, this is actually a very capital intensive program. It's funded via philanthropy, both sort of corporate and individual. But I have a team of sort of 6 individuals, almost all of them with advanced degrees, that are able to sort of help identify these emerging these companies that go to labs, that talk to sort of professors, that see whether or not there's anything that is emerging, and then get them to apply. So I would encourage all of you within your own networks as well, if you are familiar with founders that have something that's a little bit more sort of deep tech oriented, to apply to the Creative Destruction Lab. It is a centralized application process as well. So much as medical schools provide sort of a matching process, right, between individual preferences and skills, as well as hospital needs. We too do that, and so want to apply centrally with some preferences, some revealed preferences, but we try to allocate the ventures to the site that fits their needs the most. And because it's a non-residency program, it just requires travel, for 1 day every 2 months.
Finally, last questions. I understand on the space specialization that Atlanta has been selected, but I understand that it's you're teaming up with Paris.
So I should say Paris and Toronto. I wouldn't say selected. I brought it here, and so it is both sort of it is a network, which but it is still very sort of grassroots and sort of bottom up. And so yes, we are working with with a number of individuals at ESA. That was the European Space Agency. That was the primary reason. I shouldn't say the primary, but one of the great sort of benefits that partnering with Paris provides to the stream.
Charles Eubank, who comes down from New York, but was a Georgia Tech grad, whom I knew 20 years ago.
So as a person who's raised money for a startup, I couldn't help but notice you'd said initially capital access is not necessarily the issue yet. All those VCs are in Silicon Valley,
Yep.
Which I admittedly raised money also from Silicon Valley. So is there any correlation to access to that in the immediate Atlanta market? I'll tell you, my experience was it was easy to find somebody who would write a $1 to $5 million check in Silicon Valley. And if they lost it, they didn't care.
Yep.
I don't know if we have that scale in
Nope.
this market.
Or the appetite for risk, right? So, as a secondary or so very geographically circumscribed, there's a variety of, Dan will know, sort of some of this literature as well, monitoring matters as well. And so one wants to be proximate. That being said, Sequoia's opened a number of offices outside of, sort of off Sand Hill Road. These VCs are growing because they recognize that opportunities exist elsewhere. When I said it's not, the primary reason, I think, it's important. It's very hard to say to a founder, but there's often, a reason that you don't get funding. It's because the idea is not good or hasn't been de-risked enough. That's where, that aspect of the life cycle is where this program focuses. And we found that once that has been done, VCs will travel. Furthermore, this isn't a program solely for Atlanta Ventures. And so we have a we have a cohort typically of 20 to 25 ventures that are incredibly high quality, as opposed to, 1 to 2, star companies, and then everything else that's sort of going on in a smaller ecosystem. And so it changes the decision calculus for VCs, to come out. But yes, my secondary tertiary goal is to get local VCs more comfortable investing in deep tech. That is sort of very much my lofty goal. I think there needs to be much more deep tech rather than sort of software, investing, and more atoms, fewer bits. Is my increasing mantra. So,
All right. Thank you.
thanks for the question.